All right. So thanks everyone for joining us. My name is Scott Brovsky. I'm with UC Riverside's Epic Small Business Development Center, and we run a program that mentors about 220 tech startups here in Southern California. And what we do every couple of Fridays is we are thrilled to have our partners with Early Growth Financial with us to talk about issues related to CFO and financial questions from the startups and from the small businesses and entrepreneurs. So what we're going to do is I'm going to turn the screen over here to Regine. She's going to do a quick intro on Early Growth Financial. And then we have actually the founder and CEO of Early Growth, David, with us as well. And he's going to run through the presentation. During the presentation, please, there's a Q&A box for those of you that aren't familiar with Zoom. Hopefully everyone is by now. But there's a Q&A box down below. You click that and ask your question. And I'm going to ask David questions as we roll through the deck through his presentation. So with that, I'll let Regine take over. So go ahead, Regine.
Hi, everyone. Thank you for joining us today. It's wonderful to be presenting with you. My name is Regine David. I am the LA market manager for Early Growth. We are here to present on startup fundraising, but I'd give you a little bit more background about Early Growth. We are the largest outsourced accounting and finance firm in the venture space. We've supported about 18% of venture-backed startups in the US at some point in their life cycle. Currently, we have 1 in 5 US-backed companies, US-backed startup companies as clients right now. So we have a pretty national footprint in this sphere. And I like to say that we help mitigate risks from a financial perspective to early stage founders and their companies through about 5 main focuses. So we have 47 CFOs, half of them coming out of public accounting with Big Four experience, the other half with really strong financial backgrounds, with expertise in different verticals like e-com, SaaS, B2B, hardware, software, manufacturing, digital health, and verticals of that nature. And they provide financial support. They also provide fundraising support and forecasting support as well, pricing and strategic planning for our clients, and really operate as a CFO for a large company just on an outsourced basis. We also have accounting services. We have about 115 senior accountants, and they handle accounts payable, accounts receivable, monthly reconciliations, expense reporting, P&L statements, and also general ledger transactions in accordance with GAAP principles. We have a pretty robust tax practice. We have about 1,000 clients in 40 countries, and our tax team supports with corporate and personal tax preparation and filing, tax consulting if you needed them on an ad hoc basis. We also offer R&D tax credit study. And I think about last year, we got $15 million in tax credit for our clients, which is pretty substantial. We also offer 498 valuations and fair market business valuations for companies who want to offer options at some point in their future. And also we do fund accounting and fund administration and really support about 55 micro funds at this moment, right, David?
Yeah, absolutely.
Yeah. As you can see here, we've had HelloSign, Allbirds, Stitch Fix, Crunchbase, Goodreads. So we've had some really strong companies come through our doors, so to speak. And I will present David Ehrenberg right now, who is the CEO at Early Growth. You can see a few fun facts about him right here. And he will
fun facts. He
can talk a bit about himself. Go ahead.
Thank you all for coming. I appreciate it. We appreciate it. As Regine had said, at Early Growth, we work with about 18% or almost 1 in 5 of all venture-backed companies in the country. We typically work with companies when they close their first institutional round. And then on average, they're with us for 35 months. So if you think about that from a venture perspective, that means that a company's typically coming in nowadays when they hit their seed round of financing, they're typically leaving us somewhere around a Series C. But what that means is that in between that period of time, they're probably closing 2 or 3 rounds while we're working with them. And so it's something that we've developed quite an expertise at. We spend a lot of time working with our clients as they're fundraising. Our CFOs are very well versed in the proper way to raise funds. and it's something that has become a huge area of expertise for us. So hopefully this talk will be useful for you. As Scott mentioned before, it's great if we can have questions as we go through. The more interactive we can make this, the better. If there aren't questions throughout, we will definitely leave time at the end of the presentation for questions so that we can follow up with it. But let's go ahead and kick it off. Let's go to the first slide, Regine.
Okay, let's go.
Okay. So the first thing I like to talk about in terms of raising money is in 99.9% of the cases where businesses are started in the United States, those businesses don't go outside and raise external funds. Most businesses are bootstrapped. They're started on savings or on the revenue from their first initial product or revenue sales, service sales. But most companies, when they first get started, don't go out and raise money. And that's because raising money can be really, really expensive and really time intensive. Having someone have ownership in your entity, in your company, can be a pain in the ass, and there's a lot of downsides to it. But so if you think you need to raise money, think long and hard about that. And the questions that you want to ask are, does raising money give you a huge competitive advantage? Are you under time pressures? Do you need to move quickly? And will raising that money help you accelerate that timeline? Is what you're doing really capital intensive? Do you not have enough resources on your own to achieve what you need to achieve? And is there a huge market opportunity? So those are the types of things that you want to be asking yourself, because not all businesses should be going out for venture capital or for private equity dollars. Let's go to the next slide. When you are thinking about raising money, however, there's different folks that you should be thinking about at sort of each stage of the fundraising process. And Regine, this is kind of funky because we have different slides on each one. You know, you see, you want to sort of, yeah, you want to kind of toggle back and forth.
Okay.
Yeah. Okay. Oftentimes the initial area of fundraising that an entrepreneur does is a friends and family round. And it's exactly what it sounds like. It's people that are in your immediate family group, they're immediate friends, they're people you went to school with, they're people that are members of your country club, they're parents of your children's friends. These are folks that are in your immediate social circle. And oftentimes this is the first area of fundraising and the first place that people go when they're thinking about raising money. The one thing I would say about the friends and family round, the one thing that I would caution is that at 90% of the time when money is raised in a friend and family round, 90% of the time that money is lost. So, and I know everyone, when they start their business, they never think that they're going to lose. And one of the things that makes a great entrepreneur is optimism and belief and perseverance. But just be very, very careful at the friends and family round to make sure that if you're taking money in, it's money that if it gets lost, it's not going to kill the relationship. That there's no external, and that you're not going to damage it. And know that even though you have faith in yourself, that the odds are not in your favor, and so you don't want to ever put a relationship at risk. You certainly don't want to take, grandmother's retirement money or Aunt Jane's college savings plan. So just be careful about that. The next round, and is angel investors, and there's really three kinds of angel investors. There's an angel is just a normal angel investor is any high net worth individual who is investing in businesses as part of their investment strategy. So someone might invest in real estate, they might invest in the stock market, they might invest in the bond market, but they're also making investments in companies as part of their investment strategy, as part of their wealth management. And these are the high net worth individuals. They're typically not incredibly sophisticated, and they typically are giving in the smaller range, sort of $25,000 to $50,000. The second area of angels is angel networks. And these are, or the third area is angel networks. We'll get it. We're doing okay. We get it. We get a little bit better each time we do this, Regine. Scott's like a little bit,
just a little bit. Hey, actually, before you continue on angels, can we go? We had a friends and family round question. So before we go too far, let's. So John wants to know. Does friends and family funding violate qualified investor rules? I think what he's asking is, do they have to be accredited investors for the friends and family round?
Yeah. So they do. You still are counting. You still are counting.
Okay. Cool.
Counting, yeah.
Okay. Cool.
So angel networks are groups of angels that come together, and they come together to concentrate deal sourcing, so that they have more individuals that are pulling together deals from different sources, and so that they can do due diligence on deals together, and so that they can contribute together to make investments, so that they have a bigger impact on making the investments. And most regions across the United States have several different angel groups, depending on how active the early stage ecosystem is. An area can have a lot. In Southern California, there are many strong, very, very good angel groups. I think Tech Coast Angels is the largest angel organization in the United States. Scott, is that right? They've got
that's what they say. And yeah, just for those of you, I think most of you are in Southern California. So there's the main groups are Tech Coast Angels and Pasadena Angels, and then there's some smaller groups in Orange County, LA, also in San Diego. But Tech Coast Angels is the largest, and I see some of the folks here who are on the webinar. We're actually in talks in due diligence right now with Tech Coast Angels for the rounds we're helping to some of the startups that we mentor raise. So yeah, I think Southern California has a robust ecosystem. Of course, it's nothing like Bay Area, which I'm sure David can talk more about in terms of the strength of and the number of angels writing early checks. The Bay Area, of course, is the strongest in the world, as we all know, for angel investment. So,
but so the Bay Area it's the strongest in the world for angel investments. But LA's got a great early stage ecosystem for investment.
Oh, it does, yeah.
LA and Southern California. Both Pasadena Angels and Tech Coast Angels are both strong angel organizations, but there's also we're going to talk about the different folks that are investing at different stages. And LA is great, Southern California is great for angels, for angel groups, and also for micro venture capital funds, which is one of the next categories that we're going to talk about that are investing at the early stages. So angel groups are great. They can take a long time to make decisions. So when you are working with angels groups, give yourself a lot of cushion in terms of timing. They do not move quickly. The other thing is get a good understanding of how they interface with you, because what they're going to do is they're going to pull together sort of 10 to 15 people who will all put in $25,000 to $50,000, and they'll have some $300,000, $400,000 that they want to invest in you. But you want to make sure that you're not dealing with all 14 or 15 of those people, that there's a point person and that there's some sort of a streamlined communication, and understand what's expected in terms of reporting and in terms of communication on an ongoing basis, because those things can be tricky. And you especially don't want to be in a situation where you feel like you're herding cats when you're interacting with your investors, where there's just so many that you're dealing with. But angel groups are certainly a good viable option for raising very early stage money. And there's some really great angel organizations in Southern California. The last thing is super angels. And these are folks that are still high net worth individuals, and they're making investments in early stage companies, but they're making a very large number of investments, and they're acting in a very sophisticated way, much closer to a venture capitalist than, say, a traditional angel. So examples of this would be someone like a David McClure, who started 500 startups, or a Ron Conway, who was very involved with Y Combinator, a super angel in the LA ecosystem for years was Paige Craig, although Paige has now moved to Atlanta. But Paige was
Oh, I didn't know that. I knew him from my startup days. I didn't realize he had moved.
Yeah, Paige
Oh,
moved
okay.
to Atlanta. We're doing a webinar with him, or a talk with him in September. So he's
Oh,
got a
okay.
fund out there, and he's got an incubator. But
Oh, cool. Okay.
yeah, Paige is a good guy. But
Yeah,
so Paige was a super angel. And these folks, the nice thing about these folks is that they're very sophisticated. They move quickly. They operate very similar to a venture capitalist. And so if you can get the interest of a super angel, this is nice. This is nice, quick money to get. Okay, so you want to go back quickly, Regine, yeah, to the chart, the first chart when we have yeah, we're gonna go to micro VCs, but I wanted to just show. Okay, so as this chart demonstrates, at each stage, there's different folks that we're going to talk to, right? So to start out, you're going to try and bootstrap as much as you can, go as far as you can, get as much traction as you can with your own resources. Then in terms of the immediate folks around you, your friends and family around, then you start looking at angels. The first set of institutional investors that you're going to start thinking about are the micro venture capitalists. And this is after you've already raised money from angels, from friends and family. This is after you've gotten some traction. A lot of times at this round, which they call the seed round, they are looking for revenue. They are looking for customers. They want to see that you've moved the ball down the road a little bit. And these folks, these micro venture capitalists, these are not the big name micro venture capitalists that you hear of. These are not the sort of the Kleiner Perkins or the Sequoias. These are folks that oftentimes they have under 50 to 60 million in capitalization. The micro venture capitalists in the LA area are really small. A lot of the micro venture capitalists in the LA area are under $10 million in capitalization. They tend to focus on specific areas. So they'll focus on B2C, business to commerce, consumer, business to consumer, B2C, or B2B. Or they'll focus on enterprise apps or clean technology or life science. But they tend to have very specific areas of concentration, and they invest at the seed stage. So this will oftentimes be your first institutional round. And seed round of capital, typically it's somewhere in the neighborhood of $1 million to $5 million. And then it's with the micro venture capitalists. The next level, going back one more time, Regine, to that initial graph, is your more strategic venture capitalists. And these are the folks that they always used to call the sandhill folks. These are the Sequoias. These are the Andreessen Horowitz. These are the Kleiner Perkins. They're typically coming in. The first round that they'll typically invest in is your Series A round of investments. And then they're coming in a large way in your growth rounds of investments, sort of your Series C and your Series D rounds of investments.
So David, can we pause there for a sec on that
Absolutely.
chart? We can go back either way. Yeah. So just a few things I just wanted to mention, because we have, as many startups coming to us, typically to ask us to help them raise capital through our Epic program that we're doing here in the region. And I think it might be helpful to talk a little bit about, I saw you had it on that chart at the very bottom, but it is what typically happens, I'd say for 95%. So for example, like of the 220 startups we're mentoring right now, we've got 5 that we're helping raise micro VC or angel rounds for that are actually at a point where they're fundable. And so maybe we should just talk about a couple of things that whether it's a super angel or a micro VC, they're looking for, because I can't tell you how many conversations I have on a weekly basis where someone comes to me with either an MVP that's barely done or an idea that they think is so good that they can raise capital on the idea, or an MVP that is not launched, or a launched MVP with no traction. So maybe we can talk a little bit about a couple of the things that you've seen that super angels, angel groups, and micro VCs want to see, because I think that helped the audience quite a bit.
Yeah, I think it's a really good question, especially in today's climate, especially Scott, with everything that's happening with COVID. So overall venture investing has actually not gone down as a result of COVID. It's actually slightly above where it was last year. but most of those investment dollars are happening at the later stage. So they're happening with later stage companies. They're happening to companies that venture capitalists are already invested in. So think about a company that has already closed a Series B or a Series C round of funding. The venture capitalists that have already invested in that company put more money in to basically shore up that company and make sure that they were safe and they will be fine during the pandemic and that they could get through the next 12 to 18 months. So overall investing dollars has gone up. They've gone down in the early stages. So at the seed and Series A level, investing has gone down 30 to 40%. So deals are still happening at the early stage, but they're not happening with the same regularity. There's less deals. And they seem to be a little bit smaller size. So the big thing right now is you really need to show traction. You really need to show traction. And when I say traction, you need to show traction with customers, and you need to show that there's an appetite for this, and that there's a path to revenue and to exponential growth.
And then a couple of questions before we go to move on from the micro VC. So Kieran asks, would you be able to comment on InQtel? So I can comment on that. And I don't know if David, if you want to comment on that, but basically that's a venture capital firm. I think it's a nonprofit that is focused on funding solutions for the intelligence community, mainly the CIA.
The government, it's actually a governmental entity, I think, Scott.
Is it? Okay. So yeah, Kieran, we maybe should have an offline conversation about that, because I don't know that's if you're asking comments on it about, I guess the question is whether or not to work with them. I would say if they're going to look at your deal, then take the meeting. But yeah, that can also be a little bit of a different path to get involved with government entities and government funding. So we should probably take that one offline. We can you can ping me and we can talk about that one offline. And then another question came from Desmond. And I'm not sure if you may have a slide on equity crowdfunding. I might be jumping the gun here, but he basically is saying that he says, we don't plan to raise funding by conventional means, but they want to use equity crowdfunding for the first $1 million. We already have proven solutions, customers, and revenues. Does it sound like the right way to go? So I can tell you that, let David answer as well, but so we have quite a bit of experience with this, because as a region, especially here in our Riverside region and inland Southern California region, we don't have as much VC and angel activity. So we have had several of our startups that have gone the equity capital raise route, the crowdfunding route. And so we can also talk more offline about that, but we've had several that have been successful, several that haven't. What I would say is that what we've seen is it typically helps, especially if your goal is to raise $1 million. That is very hard to do on the equity platforms. And, for those of you that haven't heard of them, there's one called Republic that we've worked with. There's one called Seed Invest. There's one called WeFunder. I won't name them all. There's probably 20 of them now. But so those are some of the top ones. And what I would say is it's similar to Kickstarter in the sense that if you do go that route and you don't have a good equity crowdfunding experience in terms of hitting your goals, it's similar to Kickstarter. If you go out on Kickstarter and you don't raise your goal, or if you do a super low goal, like 50,000 on Kickstarter, and then you try to go out for investment, it's going to be really, really hard to raise venture and or angel money with what I would call a semi-successful equity crowdfunding round or a semi-successful Kickstarter round. So I don't know if Dave, you want to add anything to that, but that's what we've seen. And that's the feedback we've gotten from investors when we've had some of the Kickstarter and equity crowdfunding companies go out and try to raise subsequent capital.
I think you answered all three of the questions, Scott.
Well, I mean, I'm sorry. I just wanted, but weigh in, Oh man.
Let's jump. Okay. In terms of, so the next thing is funding vehicles. So Scott was talking a little bit about crowdfunding. There's different funding vehicles you can jump into. We talked a bit about equity and raising money when you're going out to raise money from angels and super angels and micro venture capitalists. you're oftentimes talking about raising it through equity or convertible notes or convertible debt, which we'll talk about in a second. But as you get to later stage rounds, you can also raise venture debt. And venture debt is money that is coming from typically a venture bank like Silicon Valley Bank or Avid Bank or any of the banks that really focus on the technology industry. Or there's also venture debt providers, folks like Western Technology Investments, Hercules, other folks like that. And they are loaning money to companies that is debt that needs to be repaid and that has an interest rate, but they're not loaning it based on the assets of the company. They're not loaning it based on the revenue or the accounts receivable or any of the equipment that they have. It's being loaned based on the venture capital relationships, based on a belief that the company is going to have a large upside. And in exchange for this, there's warrants that are provided as a part of this. So that's venture debt. The next slide is traditional venture capital, which we just talked about. We should probably flip those two slides. But, and then the third thing is convertible debt versus equity. So oftentimes when you're raising money at the early stages, so when you are going out and you're raising money from those angels, those super angels, and those angel groups, and also at the micro venture capital level, folks are raising money through convertible debts or convertible notes. And this is incredibly advantageous if you are the entrepreneur. What it is it's typically a very standardized agreement. They're typically are 2-page or 3-page legal documents. And it is an agreement to take money from an investor as a loan, and then at a subsequent point in time, when you raise another round of equity, that loan converts into equity at that point in time. And the advantage of this is that it's a way to raise money quickly, early on. It doesn't cost much to put a legal agreement in place. It can cost a couple $1,000s. Whereas if you do a formal equity round, that can cost $30,000, $25,000 to $30,000. So it's a way to save money. And it's also a way to not get really bogged down into the details and into the negotiations. So convertible notes are very, very common. They're advantageous to the entrepreneur. There's typically the terms for convertible notes. They're typically 12 to 18 months in duration. There is typically an interest rate for them. We're seeing 4 to 6% right now out in the marketplace. There's typically a discount. So you are providing a discount to the investors who are purchasing the convertible notes. They get to convert their money into equity at a discount, at a lower rate than the future investors that are coming into the deal. And that's because they came in early. So they get a discount, and that discount's typically 15 to 20% right now. And then the fourth element that's usually part of a convertible note is a cap. And that says that the money will not convert above a certain level. And that cap right now, we're seeing those caps at early stage deals anywhere in that sort of $5 to $8 million range. But so there's typically 4 things you want to think about. A discount, which we're seeing at 15 to 20%, duration, which we're seeing at 12 to 18 months, interest rate, which we're seeing at sort of 4 to 6%. And was that all 4? It was all 4. Are there any, Scott, are there any questions on convertible debt and convertible notes?
We don't have a specific question on that right now. Maybe when we'll come in, but we do have a question, which again, I'll let you answer first, but I can also answer, which is that, because I've been tracking this for years with all the investors we work with, but Terry wants to know, can you give us hard metrics defining traction, like number of users, customers, and amount of revenue?
It depends on the sector that you're in, right? So for every sector, traction is going to be different, and it's going to be identified in a different way. So one of the things that we're going to talk about is we're going to talk about milestone financing a little bit later. We need to sort of start moving through these slides a little quicker, but uh, you need to understand that for the sector that you're in, what are the different things that the venture capitalists are going to assign value to? What are the things that they want to see? And that traction can mean different things in terms of technology, in terms of customer reach, and in terms of expansion. Scott, did you want to jump in on it?
Yeah, I'll just say that for and this is not updated with COVID data because I haven't really I've talked to a lot of investors, but we haven't talked specifically about the traction numbers. But so what we were tracking prior to COVID was for a consumer audience play, so a B2C startup, which would typically be an app company or a web-based company. They're looking for 25 to 50,000 DAUs, daily active users, before, and this is for angel and seed. SaaS is typically looking for a $10,000 to $50,000 MRR. And also, and that's basically the amount of money you're bringing in, revenue you're bringing in each month, and not just a $10,000 to $50,000 MRR, but they're also looking at typically 10 to 15% what's called MOM, or month over month growth, which basically equates to doubling your revenue every 6 months, if you want to like make it an easier way to think about it. And then there's a bunch of other, as David said, it depends on what vertical you're in. So obviously a biotech company or an ag tech company or a clean tech company or a hardware-based startup probably wouldn't have those type of metrics before they raise their angel, their seed round. So again, it depends on the vertical, and we can talk more offline about that. We talk to startups about that literally every week as well. So and then another question just came in on the convertible notes before we move on from Mark. Hi, David. Are folks still using the SAFE or a version of it?
Yeah. So, and I'm glad you asked that question. I wanted to touch on SAFE really quickly on that. But first, before I jump into that question, just to sort of piggyback on what Scott had said, because of COVID, because of the pandemic, investors are looking to see even more traction. So it's more important now to really show that you do have that path to revenue, that you are hitting those clear metrics. And we haven't seen numbers, but the assumption would be that as we do start to see numbers, those numbers are higher and show further progress than they were before. The SAFE document is Y Combinator's and Wilson Sonsini's version of convertible notes. The big difference is that a convertible note is treated as a liability on your balance sheet. A SAFE document is treated as equity on your balance sheet. For all intents and purposes, there's not a huge difference between the two of them. It just is going to depend on what your investors have a preference for. So,
one thing I'll add to that is in Southern California, we don't see many angel investors who are excited about doing SAFE notes. Just so you know, for entrepreneurs know, typically it works a lot better if you just come out of a premier accelerator like Y Combinator, where you're going to have typically a much higher cap on your note, as David mentioned. Like instead of having a 5 million cap, you may have a 15 million cap because you've come out of basically one of the top accelerators in the world. But in general, just so you know, for Southern California, not many investors will do SAFE notes. I'm not saying none will, but in general, that doesn't happen, just so you know.
Scott, we got to be really careful on time, buddy, because
we're keep going.
we're at 20 minutes, but so let's go into it really quickly. So funding strategies. So the big thing about when you think about fundraising, think about it like it's a giant business development process. So you want to make sure that you have a fundraising plan. You want to think it through. The first thing that you want to do is you want to make sure that you do milestone financing. And we're huge believers in milestone financing. Oftentimes I'll talk to an entrepreneur and we'll ask them how much they're going out to raise, and they'll give us a number. I was talking to an entrepreneur yesterday. They're going out for a raise. I asked him how much they're going to raise, and he said somewhere between 500,000 to $1 million. And I asked him why he was going to raise that amount of money. And he didn't have a great reason for it. He just felt like that was appropriate, or that was what he was seeing in the marketplace. That is the wrong answer. Every time you raise money, you want to make sure that you are raising money at a higher valuation. You want to make sure that you are giving up less of your company each time you're going out and selling some of your equity. So if you raise $1 million today, you want to, and you raise $1 million in 2 years. In 2 years, you want to give up a much smaller amount of your company for that $1 million. So what that means is that every time you raise money, you need to make sure that you have clear milestones that you have in mind that you will achieve with that money. And you need to understand what are the key things that you need to do. It goes back to like this traction question. What are the things that you need to do in terms of traction? What are the things that you need to do in terms of milestone that a venture capitalist and outside investor will say, yes, you have increased the value of your organization. Yes, you have increased the value of what you're doing. So every time you raise money, start with the question of what key milestones do we need to achieve? Once you understand what those key milestones are, build a budget for those key milestones. Figure out all of your expenses, and then give yourself a 20 to 25% margin of error. Things are always more expensive than you think. Things always cost more than you expect them to. They always take longer. So give yourself a fudge factor. So when you're thinking about raising money, first thing you do, think about your milestone financing. Think about how much money you need to raise, and start at that level. You want to go to jump to the next slide? Then you want to make sure that the standard guidance is to give yourself 6 months. So if you know you need money in 6 months, if you know you're going to need money, start fundraising 6 months before the point that you need the money. We're telling companies to give themselves longer now. It is a more difficult fundraising environment. It is tougher out there. So start as early as you possibly can. It's going to be a long process, and it's a changing process right now. But so get out there and make sure that you're doing it. Let's jump to the next slide. Then, so you figure out how much you're going to raise. You start your game plan 7-8 months out. First thing you want to do after you've decided how much you need to raise is pick who your target venture capitalist is. And this, earlier we talked about how there's different investors at different types of stages, and venture capitalists certainly focus on different stages. So a lot of the micro venture capitalists are focusing on the seed and the Series A rounds of financing. A lot of the traditional venture capitalists are coming in at a Series A round of funding at the earliest, but are spending a lot of their time focused on growth rounds, what they would call a Series C or a Series D round of financing. But so you want to first think which investors are focused at the stage that I'm at, and then what investors are focused on the sector that I'm at. So investors will focus on business to consumer, business to business, clean technology, life sciences, med tech, and they typically have different investment focuses. And even within venture capital firms, different partners focus on different areas. So you want to make sure that you understand sector, stage, sometimes region matters. There's a lot of investors that are down in LA and Southern California that only invest in companies in LA and Southern California. So region sometimes an element as well. But so pull together all the different investors that you think could be potentially interested. Typically we see Google Sheets or Excel sheets that has all this information on it. And then once you have this list, you need to start figuring out how you can get in front of these people. And then it becomes a question of networking. And this is where it really is a sales process. And networking is important because although there are ways to apply to all these venture capital firms through their websites and through other methods, what you're really looking for is someone who will reach out to that venture capitalist and make a personal introduction for you. And so you want to do this huge networking game. So you pull together this list of all the folks that you're targeting and that you want to get in front of. Then you start looking at your own network, looking at your own LinkedIn, seeing who you have that's connected to these different folks. If you have gone through an incubator or an accelerator, or if you're affiliated with a program like UCR, you can start doing networking among other entrepreneurs in those programs with the folks that work for those programs to see who they know and if they can if they can reach out to a contact for you. There's certain organizations for early stage startups out there, like the Founders Network and Young Entrepreneurs, YPO. Oftentimes those can be good ways to do networking. And then another area of networking is service providers. So when you're thinking about who your service providers are, making sure that you're choosing service providers that are working within the technology field. So making sure that you're using lawyers who have networks within technology, making sure you're using banks that have networks within technology, an accounting firm, things like that. But so you really want to try and figure out, it's this huge networking exercise where you're just trying to figure out who can put you in touch with the right people. And it takes time, Next slide. And I think that is it. That's it. I thought we had one more slide.
So yeah, I was gonna.
That was somewhat anticlimactic, right?
I thought we were gonna go for the big close there, but
so sometimes we have sometimes at the end of our presentation we have what you need when you're going out to fundraise from a finance perspective.
Oh right, yeah.
We should do. Which we shouldn't do each of the slides in the slide deck, Regine, but we can talk about that. But we should do a high level,
So we have a couple of questions. We had a couple of questions that came in while you were going through the last few slides, and I think a couple of them we may answer offline, because we probably need to go into more detail. But Charlene is asking, when David talks about a discount to the investor, what is he referring to? So she's talking about the convertible note discount, I believe.
Yep, totally. So Charlene, so if you purchase a convertible note, let's say you purchase a $1 million convertible note, and it's today, and then 2 years later the company goes out, or a year later the company goes out and they raise a round of equity, you get a discount for that $1 million. So let's say in a year the equity the company has a valuation of $5 million. So the company's valued at $5 million. The person who had the convertible note, if they have a 20% discount, the company for them is not valued at $5 million, it's valued at $4 million. There's a 20% discount on that $5 million. So they basically get a cheaper price. They're getting a deal because they came in early. They're getting a better deal than the other investors because they took a bigger risk, because they came in earlier on. And it's typically 20%. It's typically 15 to 20%.
All right, cool. And then Kieran asks, again, going back to a little bit earlier in the deck, my lawyer suggested I convert my friends and family investments to safes. I guess he wants to know if you think that's a good idea.
Your lawyer thinks you should convert your friends and family investments to safes?
That's what Kieran asked.
Yeah, I mean, it depends. I mean, so it depends what your agreements were before. If you are planning on raising more money using safe notes, then you should certainly convert them, right? So you should keep consistency. So if you've raised money from your friends and family in a priced round, and you're planning on going out and doing a safe round, then you need to convert your friends and family over to a safe so that everyone is consistent. Be careful, as Scott said, safe is really, it's an instrument of Y Combinator and of Wilson-Sonsini. So you don't want to convert your friends and family over to a safe document and then need to go out and raise a convertible note document or convertible debt. You do want to have that consistency. So think about that. And it could also just be that, there's a lot of disputes about friends and family rounds. It can get really ugly in terms of ownership things and who owns what and what the actual terms were. A lot of times the initial friends and family rounds aren't legally documented very well. And it could be that your lawyer just wants you to clean up your early rounds, because it can be such a source of contention and problems in the future.
So we have another question that came in from Matt. He says, when are good times to do a company valuation, and are some do's and don'ts, and what are some do's and don'ts in terms of how it's done?
Yeah, so evaluation, it's a it's a legal requirement. It's called your 409A valuation. It's a legal requirement that Congress had enacted in 2002 after Enron, um, after the Enron fiasco, as part of Sarbanes-Oxley. And basically, the rule on valuations is that if you are a privately held company and you give out employees stock options, you need to get a valuation done every 12 months or when there is a significant event. And a significant event primarily means you're closing a round, although something like COVID was a significant event as well. So people had to get new valuations for COVID. So if you're an early stage company right now, and it's just you and perhaps some other co-founders, you don't need a valuation. But once you raise money and start hiring employees, you need to get a valuation done every 12 months or when you're closing a round. Scott, you're on. Scott, you're muted.
I'm sorry, I'm muted there. I was just trying to answer questions and type questions. And okay, so any other questions? We've got a few minutes left. If you have any questions, those of you who joined late, you can click the Q&A button and type in your question. The other thing I think we might want to just touch on, I think, is that as David mentioned, it is really important to have the right partners when you're building your or scaling your startup. And it is something to take seriously. We've had a number of founders, especially first-time founders, who said, "Oh, I don't really care. I'm just using my bank that I've used since I was a kid, or I'm just using my mom's friend who's an attorney." I wouldn't do that. As David mentioned, it is absolutely critical that you have service providers and partners that can help you, not just with their expertise, like for early growth with CFO work and accounting work, but also that can help you with introductions. So for example, that's why we partner with teams like Early Growth. We also partner with a bank called Silicon Valley Bank. Not that there aren't other great banks and other great solutions, but you definitely, especially if you're a tech company, you're going to scale and raise capital. It's really important to think about those things. So as you start to grow, reach out to me and our team.
Can I piggyback on that?
Yeah, go ahead. Yeah.
I think it's especially important for reach. So if you're in an area that's not necessarily one of the tech epicenters,
great point.
It's a great way to sort of access that tech epicenter, right? So having making sure that you have a channel into sort of the LA venture capitalists, you have a channel into the Silicon Valley venture capitalists. Service providers. They're all going to charge you the same amount of money. You want to get as much out of them as you possibly can.
Yeah, and I just quickly, for those of you that are in our region of Southern California, the Riverside and Inland Empire region that aren't on the coast, that's a great point, and we do a tremendous amount of that work. And also just realize, especially, we work with a lot of first-time founders in our region, and we just helped one of the startups that we helped bring the technology out of the university, close $1 million seed round, and we help with them with 40 introductions to angels and micro VCs or early stage VCs. So, don't think that it's that easy. And if you don't have those connections, as David said earlier in the presentation, you've got to figure out how to network into those investors. So we have a few more questions just came in the last few minutes. Manny asks, what is the best way to convert the founder money? Is that something that is the right thing to do? I'm not exactly sure what he's asking. Convert the founder money. Oh, you're saying okay. So like say someone put $100,000 into the startup and then you're going out to raise capital. I think that's what he's asking, David.
Yeah. So you want to make sure that you're thinking about, when you're thinking about equity allocations, when you're first initially starting out the company, if people are putting in different levels of money, that should have an impact on the equity allocation implications. And if founders are putting money in after the company's starting, they want to make sure that actually relates into increases in equity as well. So just make sure that you're thinking about it and the mechanisms are in place. Really good question to talk to your lawyer about and make sure that it's in your initial documentation.
Charlene asks, we want to have a partner come on board and give them a percentage of the business. What is a good dollar amount to have?
Scott, you froze, my friend. You froze. I'm sorry.
Oh, I did? Okay. Am I back?
You are back. You're totally back.
Okay. Charlene asks, because as Charlene says, we want to have a partner come on board and give them percentage of the business. What is a good dollar amount to have them invest, and what percent should we give? We are thinking $40,000 to $50,000.
I mean, that's such a,
that's a hard one to answer.
Yeah, it really depends. It depends on what they're going to achieve, right? So it depends on, how. So let's go back to this whole question of milestone financing. So when you think about when you're thinking about dollars that you want to raise, you always want to think, what can I achieve with those dollars? What are the key things that I can accomplish? And if I accomplish those things, how is that going to change the value of my company, right? So when you're thinking about raising money from a partner, think about, okay, what am I going to be able to achieve with that money? And then I think about what do I think the value of my entity is now? And then after I'm able to achieve those different things, what will be the value of my entity? And that will help you define it. But you've got to get into the specifics, right? You've got to get into the specifics. There's not sort of these high level sort of overriding rules that sort of govern those types of things. You need to sort of do the dirty calculation.
Okay. Yeah, we can talk.
Right?
Yeah. You can't really answer that one quickly.
What else are you going to do, Scott? Right?
Yeah.
That's a hairy one, right?
Yeah, that is definitely. Terry asks, what about investments with a social good component? Does that come into play, or is it all bottom line and growth potential? If so, where? Traction, valuation, et cetera. So I think, go ahead and answer, David, and I'll also chime in on that, because we've worked with some startups that are raising from a social good perspective.
Yeah, so there's a couple different. There are impact investors that are out there, and so we know a couple funds that are impact funds that do investments with a social good component. They are still looking for good, healthy businesses and market opportunities, but they are investing with a social good. There's also a large number of company investors that are in spaces like clean technologies that are also doing it from a social good perspective. So you can find investors that are out there. There's also other programs that are available outside of venture capital dollars for social good. There's a lot of grants and other things that are available out there for businesses that are trying to do good things.
And I just add to that, just a little side note. We've had some luck with family offices, so you might want to try some family offices, because sometimes they have a little bit more flexibility in their investment thesis than a VC that's taken on different LPs. Okay, Mark asks. Oh, and actually, I hope you're joining us for one of the 30-minute one-on-ones. So I think you and David are going to want to catch up since you know each other. Mark Hatch asks, are founders using A and B shares much anymore?
How are you doing, Mark? What was the question?
Are founders using A and B shares anymore? So different types of shares for.
Yeah, Mark. So they are, right, but the definitions have all changed. So what used to be a Series A round of funding is now a seed round of funding. What used to be a Series B is now a Series A. So everything's sort of accelerated. So the question is that there's the way that venture capital is traditionally referred to. The first round is called a seed round of funding. The second round is called a Series A round. And then it goes Series A, Series B, Series C. And there's certain each stage connotated typically a certain timeline and a certain amount of money. So
I think he might also have been asking, in terms of different share types as you're doing your raise, so that the founders would get more protection or more rights than maybe the employee shares. So it's almost like a preferred versus a common share thing. But I think we're going to be talking to him in the 30-minute session, so we'll get more details from him then. So last question from Doug. And again, this goes back to the equity conversation, which is tricky for all startups. Any comments about the slicing pie approach? So that's just one method that's used to help startups decide who gets what equity in terms of the founding team. So David, do you have any comments on the slicing pie approach?
No, it's commonly used. It's probably, so I don't have, I know it works for some, it certainly works for some founders, and it gives a framework. I think the important thing is to talk through these issues early on and to make sure that everyone's very clear and that there's no misunderstandings and that things are legally documented. But I think the slice and die approach is nice because it facilitates that conversation, Scott.
Yeah, definitely. I mean, it's pretty much what you can negotiate with other people that you want to have on the founding team, and also early people you're going to bring on, like maybe a CTO or a CMO or another executive position. It's really what you can negotiate and what's fair to everybody and what people will accept. It's a nice methodology, and it forces you to talk about it and create transparency around it, right? And yeah. So
we see more issues around this than any other legal issues. I mean, it's a big deal.
So I'm gonna wrap things up. The rest, I see Matthew and Charlene's questions. Ping me with an email. I'll get those answered for you. I'll get you the info, and because we got to move on to our 30-minute sessions, which but I'm just gonna wrap up.
Can I grab a coffee really quick? I'm gonna grab a coffee before we jump in.
Yeah, go ahead. I'm just gonna wrap up here. So go ahead.
Are we taking this one?
It's in the chat. If you can grab that one, can you send him the chat for the next one, Regina or Carolina, so we can get to the right one?
Okay. Yeah.
Okay. Cool. All right. So just want to thank everyone for joining us today. Really appreciate David, Regine, as always, coming in, answering your questions about fundraising and other finance related and accounting related questions. We're going to do these at least every couple of weeks. We may be moving them to once a month. We're going to get back to you with the upcoming schedule. We'll be talking to the early growth team about the upcoming schedule here in the next couple of days. And that's pretty much it. This is our program. It's called Epic SBDC. It's through UCR. As I mentioned, we work with about 220 tech startups and also scalable small businesses. So if you want to get in touch and you want some help, we have 15 mentors who have experience across a bunch of different, not only verticals like clean tech, ag tech, biotech, SaaS, et cetera, but also horizontal expertise. So former CEOs, COOs, et cetera. So get in touch with us if you need help with your startup or your small business. And until we meet again, we'll see you next time. So thanks, everybody. Take care. Bye.